Hey, my name's Michael Iliff. I'm a licensed loan originator with South Point Financial Services. I've been with the company for just over a year, or about 591,840 minutes. And I tell you what, I've loved every single minute that not only have I been with the company, but I've been a licensed loan originator because I get to help renters achieve the dream of homeownership. This is
My name's Angelica, and I'm also with South Point Financial Services. I'm actually a corporate trainer here with the company. I've been in the mortgage industry for 25 years, and what stands out about this company is not only do we treat ourselves in here as family,
hey,
but we also treat our clients like family, right? We try to take, or I would say, exercise every bit of ounce to try to make sure that we make every client that we're working with a homeowner. Um,
we found out a way. We find a way to yes. We find a way to
right.
yes you into homeownership. We are a direct lender. That means we process, originate, underwrite, and fund all of our loans in house. We're not like a brick and mortar bank where we'll give you an auto loan, a boat loan, a credit card, and a mortgage all at the same time. And we're not a broker where we take a credit application from you and shop that between 20 or 30 different banks. We're kind of a hybrid in the middle where we have that flexibility, such as a brick and mortar bank will have. And we also have the best rates available, such as a broker's going to shop for you. We're the one stop shop. Another thing that I love about the company is the support that we have and the access to resources and the availability that's there. My vice president is 2 offices down from where I sit. If I don't know something, and I'm going to be the first one to give you that answer, I don't know, I'm going to go ask her. If she's not available, I'm going to talk to our sales manager. If he's not available, I'm going straight to the top and I'm talking to our CEO. It's really that hands-on here at South Point Financial Services. So when we're starting taking your application for pre-approval, if there are unique situations that myself or the loan officer that you're working with hasn't heard of or they haven't dealt with it in a while, we're going to make sure that we're giving you the best mortgage advice possible to help you achieve your dreams of homeownership. Today, we're going to be talking about the stages of homeownership, and how many stages that we talk about is 7. The first one is a pre-approval. What you're going to do getting the pre-approval is reach out to somebody like myself, licensed loan originator. Getting pre-approved first before you shop for homes really gives you a competitive advantage, and you're really one step ahead towards achieving that dream of homeownership. Not only are you able to know what your buying power is, but you also know, hey, I talked to a loan officer, they have an upfront automated approval on my application. I've already sent them some documentation to verify my income, verify my assets. So once you do get your contract accepted for the house that you find, you're one step ahead and closing is going to come that much sooner. The second step after your pre-approval is reaching out to a professional real estate agent. There's some great agents in our area and the area that you're working with. And being a first-time home buyer, it's really paramount and important that you reach out to a professional agent who can help guide you through the process of finding your dream house. You don't want to end up with the wrong one because we are talking about a 30-year mortgage here.
right.
And you don't want to jump in over your head. And back to the pre-approval, the importance of getting pre-approved first. You know what your buying power is, so you're not looking at houses that are out of your budget, and you're not looking at houses that are under your budget and having to settle for something that you would actually be comfortable purchasing. Now, after you've been searching for houses with your agent and you found the perfect house, you're going to enter in a sales contract. And once that contract's accepted, myself, the loan officer, kind of takes a step back, sits in the back seat of the car, and now Angelica's your driver.
Right. So just to kind of cover some topics, once you actually go under contract, Mike, just to kind of touch just some of the expenses that upfront expenses that they're going to have, right? Once they go under contract, we're looking at what the earnest money
Yep.
deposit. Um, we've got home inspection fees, right? Most times the home inspection fee will range anywhere between $100 to about $300, you would say. Um, these are just things that you would, this is more a conversation between you and your realtor, but just to kind of put that information out there. The next step would be what, Mike has gathered all your information and we are actually verifying all your information, right? We're taking your W 2 income, right? Verifying that with your employer, verifying the information that's on your pay stubs. This is where we go in depth as far as just verifying all the initial information that was given to get that underwriting approval when that pre-approval was issued. Then it goes into a stage of underwriting, right? That pretty much all those documents are packaged up and given to an underwriter that's actually signing off and issuing what's called a conditional approval based on, just additional documents, right? Things such as verifying that your earnest money cleared, verifying that you have the funds to close, updated bank statement, simple documents. And then she'll issue what's called a clear to close, right?
Woohoo!
Closing keys. Right? That's the fun part. That's the part that everybody is waiting for, right? To actually attend closing. So what we're actually doing is just pretty much walking you through the steps of what all consists of getting that pre-approval so that that realtor can take you out and show you homes and actually put bids in. Because the reality is, right, a realtor cannot put in a contract unless they have what?
A pre-approval.
Right. So we're actually getting into that. I personally named this thing CIA, right? Not the government CIA, the mortgage CIA, right? And what that consists of is credit, income, and assets. So Mike, let's get into it. What are some of the questions that a client asks you as it relates to credit? Once we pull credit and they may see, a difference in their credit versus maybe a monitoring system that they're reviewing.
Well, a lot of first-time home buyers think that they have to have perfect credit to purchase a home, and that is a huge myth to homeownership. Just because you have a low score doesn't mean that we can't, one, improve that score, but most importantly, doesn't mean that we can't work with you at all. At South Point Financial Services, we work with home buyers with credit scores as low as 580. If you're anything lower than that, reaching out to a loan officer like myself or another great loan officer with this company, we'll be able to review what's making up your credit score and kind of give you a game plan on what you can do to change it.
Mm-hmm.
Before you're getting into home ownership, most people who even may not even be thinking of home ownership have access to many resources where they can monitor their credit. It's a big what if. Unfortunately, it's nothing that we're taught in school, at least when I was in school back in the day.
Right.
I didn't know what credit was. When I got out of school, I jacked my credit up. I didn't know what it meant, how important it will be, or excuse me, how important it would be. So I spent years rebuilding and repairing my credit. Now, when you're looking at these credit monitoring services such as Credit Karma or the free applications you get with like your Discover or your Capital One card, you may be seeing low scores, you may be seeing high scores, and then when you reach out to a mortgage loan officer to get pre-approved, they may tell you a completely different credit score than what you pulled from your Credit Karma.
Mm-hmm.
The reason being is in the mortgage industry, we're using a mortgage FICO model. Every financial industry has a different credit scoring model. There are three credit reporting agencies: Experian, TransUnion, and Equifax. And when we're looking at getting you pre-approved for a mortgage, we're looking at the middle of those three scores. So if one of those scores is a 600, you have another that's a 650, and another that's a 700. Even though you have a low score of 6 and a high score of 7, your qualifying score is going to be that 650, which is the middle of the three. And back to it being different than your Credit Karma or the consumer models, those consumer models don't take into accountability the way that the mortgage models do, such as your payment history, the type of accounts that you have, the length that those accounts have been established, and most importantly, what your balances are on those accounts. Mm-hmm. What can high balances do to scores, Angelica?
Tank it.
Absolutely.
Yeah, the best way for me to put that would be, you want to show that you have credit, but you technically don't need it. That's the best way for me to put it. Yep. They just want to see that you don't have, you may have a credit limit of $500. They don't want to see that credit card maxed out.
Correct.
Right? They want it. The myth is that they say keep it under 30%. I preferably like to say keep it under 10%.
Absolutely.
Right?
Absolutely.
Would you agree with that?
Yeah, absolutely. And we have tools at South Point. It's called a what if simulator, where if you do have higher balances on your credit cards, or maybe no balances at all, and you might have an expense coming up throughout the mortgage process, we can simulate what either paying down or adding additional balances to those cards could do to your scores. It's a great resource that we have access to. I've helped many clients out changing their scores and giving them a game plan to pay down some accounts. And like she was saying, you don't want to use the credit that's available. It's there if you need it in the event of an emergency, but the best way to borrow money is to show people that you don't need it. Now, I know the majority of people need a mortgage because I don't have $300,000 laying around to pay cash for a house. So I do need a mortgage, but I don't need to use 50% of my credit limit.
Right.
Some people do, some people don't, but if you don't need it, folks, don't use it because it's just hurting your score and it's impacting your ability to purchase a home and achieve the dream of home ownership. Now, the next part of our pre-approval puzzle is the I in CIA. And what is that, Angelica?
That's actually your income, right? And we classify this into two different brackets. We've got our W-2, wage earner, right? That's someone that's working for a company, receiving pay stubs, receiving W-2s, having taxes taken out. And then we have our self-employed client, right? This is the entrepreneur that works for himself, right?
Go get her.
Right. And realistically, we don't know your income unless you file your income with the IRS. The unfortunate part about that is that, you know, we have a lot of self-employed clients. I would have to say that write off a lot of their income.
Yes.
Right. So these are all things that you have to consider when you are actually looking to purchase a home, right? Whatever income it is that you're reporting to the IRS is the income that we're using. Most times with self-employed, we need 2 years of tax returns. Now, in some cases, we've had it to where they only require 1 year, right?
Correct. And that's the case if you are a self-employed borrower or a business owner who has that business or self-employment history established for 5 years or longer. Most of the time, if you've been in business or you've been self-employed for 5 years or longer, we're only going to need your most recent year of tax returns.
Right. But to be on the safe side, we normally ask for 2. You know, we're not going to know up front if you need that 1 year or not. So we go with worst case scenario, asking you for 2, making sure that you actually qualify with that income.
Right.
And then there are other employment, I would say, that falls into that self-employment, right? Someone who's a contractor receiving a 1099, right? That's a self-employed individual. A travel nurse, if you're receiving that 1099, you're also considered self-employed, right? So we're taking the income that's on the tax return. Now, what's the difference between a W-2 and a self-employed?
Well, when you're W-2, everybody, it seems like, has their hands in your paycheck. You may have a salary of $100,000 a year, so you're expecting that $8,200 a month to hit your bank account, but Lord bless it, it does not for whatever reason. Uncle Sam's got his hand in your pocket, you're spending money to your 401k, you got to pay towards your benefits. You know, so you may be expecting $8,200 in your bank account from your direct deposit, and you're only getting $5. We're not going off of what gets deposited in your bank account when we're qualifying a mortgage applicant who is a W-2 employee. We're going off of that higher amount, that gross income, before taxes, expenses, and deductions. That's your qualifying income. Like Angelica was saying, when you're 1099, the money that you actually see and that goes in and out of your account every single month is not what we're qualifying you for. Right. So you may, as a self-employed borrower, you may say, oh, I make $100,000 a year. What do you mean I don't qualify for that mortgage payment? Well, Billy the borrower, you sent us your tax returns, we saw your deductions, and your income after all those deductions is not enough for qualifying income at this point in time. We're not telling you that you can never buy a home based off of you being self-employed. We're just saying, based off of the information that you provided with that year or 2 years most recent tax returns, that there's not enough qualifying income there for that amount that you're requesting, or for any amount at all. It all depends on your individual situation and your individual scenario. We're not the tax police. We're not going to be saying, why are you deducting this? Why are you deducting that? We're simply looking at what those deductions are. We're allowing what's allowable, such as mileage deductions, to be added back into that. But we are having to follow those guidelines and see and qualify you based off of your income after your deductions when you're self-employed. Another income situation that can be unique is part-time work. We are able to use part-time work even though you're not a full-time employee. However, if you are wanting to use part-time income as qualifying income on your application, we need a 2-year history with no gaps of part-time employment. So if you just picked up another part-time job because you talked to another loan officer, said you didn't have enough qualifying income, you got your 30 days most recent paycheck stubs, we don't have enough yet. We're going to need 2 years of history. I don't need to see 2 years of paycheck stubs from that part-time employment, but we do need that 2-year history. And Angelica, with all the work that she does and the processing and underwriting team do on the back end, they're going to verify that 2-year history for us. So once you tell me we have the 2-year history, we're off to races with using that as qualifying income. Another unique situation for income could be trust distributions or IRA distributions. We're able to use that as income as long as we have a 3-year continuance. So meaning, if you are receiving $1,000 a month from an IRA distribution, there has to be at least $36,000 in that account to show that you will be able to receive that $1,000 for 3 years. And you may be saying, well, that's cool because it gives me enough qualifying income, but it doesn't make any sense because the mortgage is for 30 years, Mike. Doesn't make sense to me. It's the guideline. Take the extra $1,000 a month.
Right.
We'll make it happen.
And then the next, the A in that CIA is actually assets, right? This is where we dig deep.
Show me your assets. Where's the cash, baby?
Show me the money.
Hey.
Assets now can consist of, checking, savings, stocks, 401k, mutual funds. What are some of the other ones?
Bonds.
Bonds, right. Anything else?
Cash under my mattress?
No.
That's right. We can't use cash under your mattress because we have to verify these assets. Meaning, if you have $10,000 in your bank account, if that $10,000 just got deposited last month, we have to find the source of that. We have to source it. It's part of the mortgage process. So when your loan officer's asking, hey, where did this money come from? Don't get defensive because, again, we're not the IRS police. We're not here to audit you. We just have to have a paper trail to explain to processing and underwriting where that money came from. Now, if you're receiving direct deposits, whether it be weekly, bi-weekly, or monthly from your employer, we can see that on payroll, we can see that where that's coming from payroll. That's a regular deposit. But if you have a $10,000 deposit or maybe larger, we're going to have to source that. Unfortunately, we're not allowed to use cash as an asset when it comes to qualifying a mortgage. Your funds have to be in an account for a minimum of how many days?
2 months.
2 months or 60 days. They have to be what's called seasoned. Just like a steak, gotta season that baby if you want it to be right. So now that we've discussed that you have the qualifying credit scores to support a mortgage, you have enough qualifying income to support the monthly payment, and you've got the qualifying assets to support your down payment and closing costs, it's time to issue your pre-approval letter and for you to go out and get in contact with a real estate agent to find your house. So folks, click the link below to get in contact with us today. Thanks for watching.